it's a beautiful Tuesday morning right here in Lagos, Nigeria. Good morning, good evening, wherever the world you're watching from. It's Business Morning live on Channels Television. I'm Ladi Williams. First off, let's take a look at what's happening in the markets. We see oil prices steadied in early Asian trade today as weaker U.S. dollar lent support, although rising shale production and fear that stubbornly high inflation could lead the world economy to a recession limited gains. Brent futures rose 9 cents to $91.01 a barrel in early trade, while U.S. West Texas Intermediate crude futures gained about 6 cents to $85.52 per barrel. Dollar fell against a basket of major currencies after Britain's new finance minister, Jeremy Hunt, axed off the government's so-called mini budget, lifting the risk appetite. The dollar index, a basket of currencies, dropped 0.82% to 112.11 points, making the weaker dollar cheaper for U.S. buyers, oil buyers. And now to the grains market. Now we see U.S. wheat futures ended slightly higher, but closed well off their session peaks as traders monitor developments in effort to keep the Black Sea shipping lane open for Ukraine grain exports. Corn futures sank on seasonal harvest pressure, while soybeans firmed on bullish export data. That's according to traders. Now, wheat surged early, recovering from sharp declines in 3 of the past 4 sessions after Russia told United Nations representative that the extension of a Black Sea grain deal was dependent on the West easing restrictions. And the Petroleum and Natural Gas Senior Staff Association of Nigeria, PENGASSN, have been urged to procure the relevant skill sets needed to balance their task in the oil and gas sector for a smooth movement to energy transition in line with the global best practices. While speaking at the PENGASSN Energy and Labor Summit in Abuja, the Group General Manager of the National Petroleum Investment Management Services, NAPIMS, Mr. Bala Wunti, says there is compelling need to balance energy transition and energy security. Take a listen.
The Petroleum and Natural Gas Senior Staff Association of Nigeria, PENGASSN, is holding this summit in Abuja to get its members to brainstorm on contemporary issues affecting the union, especially in the light of current discussions on alternative energy sources. The Group General Manager of the National Petroleum Investment Management Services, NAPIMS, admonishes them to keep learning new trends to ensure their continued relevance.
We know that oil has never exited. We know gas has never exited. And it therefore means that the world has realized that fossil fuel is still very, very relevant. I think if there's anything I would like to leave this house to know, is that if you are a PENGASSN member, if you are an oil and gas member, be proud that indeed this energy source is still very relevant and is going to remain relevant for another centuries. If we go to the next slide, you see the impact of the so-called energy transition anyway. You see the confluence of the energy market, impact on investment, as well as finance. We all know at the base of this triangle, finance and investment, they go together. And the consequence is that you have to be able to produce energy that will meet the market demand.
For the chief host of the event and national president of PENGASSN, it is not proper to leave the workers out on the conversations on energy transition.
The most important asset has been left aside. In all these conversations, the most important of them all, which is the human capital, there is no conversation as of today all over the world that has inculcated how the human capital, how the workforce is going to transit. It is based on this that we felt that as PENGASSN, we are a responsible senior staff association that should start thinking on how this is going to affect on our workforce, on how this is going to affect the most priceless asset in the oil and gas value chain. That is the human capital.
The participants at the summit agreed that technology and innovation will be key to the future of the energy industry, which will require workers to continue to acquire new skills.
And now to our first conversation. Well, Nigeria's inflation rate came in red hot yesterday. That's for September, rising for 8th consecutive month, hitting a fresh 17-year high. Let's drill down now numbers with Dumebi Oluwole, analyst, financial derivatives company, join us right here in the studio. Dumebi, it's been a long time.
Yes,
Great to have you back.
Thank you. Thank you.
So looking at this, 20.77% is in line with expectations?
Yeah, the market did expect inflation to continue to increase, but the expectation was that it would increase, but at a slower pace. And that's because we're headed towards the harvest season, although there are lots of things now, coming in place that are, raising eyebrows about how the harvest season is going to look like. And the number one issue right now is flooding.
Right.
So the flooding is hitting like the major food producing states for Nigeria. For example, the Lokoja flooding it washed away like I think about 100 hectares of rice farmland, and it also affected Olam as well, where they had to incur a high economic cost of almost like $15 million of farmland lost. So the flooding is having an impact there, and the National Emergency Agency, they did say that 13 states are going to be affected, and all of these 13 states, they bought the around River Niger and River Benue, and as you know, Cameroon as well is going to release their dam. They're going to continue doing that. This flooding is not ending anytime soon, and that's going to continue to affect harvest season. Farmers are beginning to opt for premature harvest, and we don't yet know how that's going to look like, but from all indications, the harvest is not going to be as bountiful. The flooding is a major threat to the harvest season, which is in Q4, and we likely would see inflation edge higher because of this impact. And right now, demand for food items and various commodities are still very high, and we're headed towards, we're already in the ember months. We're headed towards the festive season, and most likely, when demand increases and supply is still this thin, and supply is even going to probably get thinner, we're going to see food inflation jump beyond the 23% that it already is, and headline inflation will also continue to increase. But apart from the food inflation aspect of it, there's also the fact that inflation right now in Nigeria is not only driven by, cost-inducing pressures and supply-inducing pressures, but there's the major impact right now is also coming from forex. So the fact that the naira continues to lose value and depreciate, naira fell to a low of 746 naira per dollar at the parallel market, and with that happening consistently, we're definitely going to see the impact of the exchange rate pass-through effect to commodity prices, on that regard. And we're also seeing that as election spending is increasing, the fact that campaigns have already started, and there's also an increase in ways and means advances from the CBN to the federal government. We're seeing an uptick in money supply. That as well is going to, continue to mount pressure on Nigeria's inflation rate.
And with all of this, it doesn't seem like it's going to peak, at any point. It seems we're even going to tick higher with all of these.
It's still going to increase, although the month-on-month inflation did, decline, indicating that inflation is probably headed towards a tipping point and, could begin to fall. But like I said, with the flooding impact, this was in September. Flooding is happening right now in October, and it's probably going to continue till November. So with the flooding impact, we're definitely going to see that, outweigh, the harvest season, because with harvest, we expect that there would be an increase in food supply, and that will taper prices. But now that the flooding has happened and it's affecting major producing states of the country, it's affecting Benue, it's affecting Bayelsa, it's affecting Adamawa, Nasarawa, Delta. These states are responsible for commodities like rice, garri, tomato, pepper, onions, the main things that people consume, even livestock produce as well. And these commodities are affected largely. So, and these are things that people consume on a daily basis. Even commodities like millets that people have, are moving into.
Right.
It's also affected. So, and demand is going to increase.
An environmental war.
Exactly. That's what it looks like right now. So, apart from all the other food security threats that had already been in place, like Boko Haram, herdsmen clash, banditry, all affecting farmers from going to their land to, plant and also harvest. Apart from all those other structural factors, now this flooding is happening, and as the Lagdo Dam release continues, it's going to get worse. And, there's also the impact of climate change. Right from time, Nimet had already come out to say that, precipitation levels of River Benue and River Niger were going to definitely rise because of climate change impact. And that combined with the Lagdo Dam release is, worsening compounding the issue. Yeah.
All right. We did get that 150 basis points hike at the last MPC meeting.
Yes.
It's still ticking up. The CBN governor said as long as it keeps going up, talking about the inflation rate, they will keep hiking.
Yeah,
so maybe another 150 basis points on the card, maybe for the next meeting.
I mean, we're not really looking at that right now. And the reason is because interest rates are already increasing. Even though it has taken some time for the other interest rates to rise, that's the treasury bill rate. But the truth is that right now, like, they're already increasing. So there might be the CBN might want to withdraw or might want to hold on increasing interest rates again. But I mean, they are being aggressive. So it's more of like a 50-50 chance that the CBN would actually increase interest rates, continue its aggressive approach towards taming inflationary pressures. But at the same time, because interest rates are already increasing, meaning that the hike in interest rates is beginning to take effect in other markets, and investors will start pulling out funds, towards, so meaning that as interest rates are increasing, liquidity is being mopped up already within the system. And that's because people would start, investors would start putting their money with fixed income instruments, and that as well would, that would definitely mop up liquidity within the system, and then begin to reduce inflationary pressures. And I remember that I said that money supply is also one of the reasons why inflation is also increasing. So from that angle, inflation rates could, we could see inflation rate begin to reduce, but not as much, because because now food inflation, which is a major dictator towards the direction of headline inflation that accounts for over 50% of Nigeria's inflation basket, is having a major hit right now because of the flooding. So that completely outweighs the impact of the money supply mopping. But like I said, it's a 50-50 chance. The CBN might decide to continue its aggressive stance towards taming inflation rate, because inflation looks like it's going to continue to increase, and even increase at a faster pace now because of the flooding impact. But interest rates are also increasing, so they might want to, even if they're going to increase, maybe not as much as 150 basis points, because investors now are looking at putting their money in other fixed income instruments that are already increasing. I mean, the Treasury bill 364 days tenure is already as high as 13%, coming from about 6%. So investors, it's attractive right now to investors. There's an incentive now to buy treasury bills and mop up liquidity. But the other downside to it is what is happening with the NGX. We're seeing that because there's an inverse relationship between an increase in interest rates and stock prices, we're seeing the stock markets definitely take a hit. And that's why I'm saying that the CBN might not want to be this aggressive with increasing.
You think they'll care about the markets at this point?
I mean, they might want to. They might want to, because investors, even though investors right now like to have a balanced portfolio. You don't only want to put your money in treasury bills, and especially with the fact that they're seeing that treasury bill rates in Nigeria are not exactly as steady. They might be 13% today, and it begins to reduce. And they want to balance their portfolio to have some of equity, some of treasury bills. But like I said, it's a 50-50 chance. And even if the CBN will increase interest rates, it might not be as aggressive as 150 basis points.
And I'm talking about the NGX, seeing it's definitely on a downtrend, at this point. I'm wondering, where's the best place to make money in these markets?
I mean, like I said, the truth is, it's just best to have a balanced portfolio, because real estate is not looking so attractive.
Cash
and apart from that, apart from even having the balanced portfolio, we're having a balanced portfolio right now is for people that actually have the money to invest.
Sitting on the sideline.
Interest rates increase right now is not an incentive to the common man who is just looking for money to get by on a daily basis. So interest rates are increasing, yes, but is that an incentive for me to put my money in the bank and have just maybe a 1% increase in interest on savings rates? Do I really want that, or rather I'll have cash? So normally
it's better than cash, though.
To be honest, the layman wouldn't want that, because right now they want to consume. They need money to consume. There's there's an increase in cost of living, and everybody wants to be able to get by on a daily basis.
Right.
So if you're earning 200,000 and you have to account for your rent that has already been increased. You have to account for transportation that is already increased. You have to account for fuel that is already increased. You have to account for food that is increasing on a daily basis. Where is the money for investment or keeping in the bank to accumulate?
Right.
People would rather, having that 1% increase or having that 1% interest, they would rather, want to have the cash, to spend. And remember that with the fact that interest rates are increasing, we're supposed to see an increase in marginal propensity to save rather than consume. But right now, we're not really seeing that because majority are falling below the poverty line. People are just looking for money to just get by on a daily basis. So instead, what we're seeing is maybe not an increase in consumption, because the real value of your income is not as high as what it used to be before because of inflation. So people are they're just living, just getting by on a daily basis. Consumption is still exactly what it is, but savings rate is not increasing.
All right. I'm sure investors just hoping for a bottom somewhere.
Yes,
we'll keep watching.
Yes.
But what's happening with wheat prices? I saw it's eased.
Yes. So, and that's because of, and that's happening despite the Black Sea optimism that's currently going on. At some point in July, Russia and Ukraine, there was this agreement for the Black Sea operations to continue. And the Black Sea is where grains are moved, are transported to the global market from Ukraine and Russia, but particularly Ukraine. So there was some agreement for that operation to continue so that Ukraine could, sell off its grains and actually make some money. And that happened in July. The reopening of the Black Sea happened in July. And although there are still backlogs of ships with grains, tons of grains that have not yet, made their way to the global market, and that's why we're still seeing some of these grain prices, remain volatile. But regardless of that, Ukraine has been able to sell at least 6.8 million tons worth of wheat and other grains to the global market for them to generate some revenue. But right now, with the fact that Russia has intensified, its missiles to Ukraine, so there's some negative sentiments towards that area, and it's like the backlog right now is increasing. At the moment, there are over 35, trapped vessels with grains, that are supposed to have made their way to the global market. So wheat prices, not only wheat actually, other grains like corn, barley as well, yes, and sorghum as well, other grains that Ukraine sells to the global market are currently trapped. So they're just the negative sentiments or mixed market sentiments, let me put it that way, mixed market sentiments is what is making wheat prices, very volatile right now.
And it'd be great to see those prices actually come down.
Yes, and that would be good for that would be good for Nigeria. If wheat prices soften, it would be good for Nigeria because Nigeria is a net importer of wheat.
Exactly. All right, Jumebi Oluwole, thank you so much. Always great to have your perspective, and congratulations on your baby.
Thank you so much. Thank you.
All right, now, so we're talking commodities there. After the break, we'll be looking at Nigeria's debt level and options to help us manage it. That's our next conversation. Do stay with us. This is Business Morning. Welcome back. Now we'll be talking about the dreaded D word, that's debt. We see domestic debt push Nigeria's total public debt stock from 41.60 trillion naira as of March 2022 to 42.84 trillion as of June of the same year, showing an increase of 1.24 trillion naira in 3 months, according to the Debt Management Office. And we also got that screaming headline from Bloomberg, quoting a comment from Finance Minister Zainab Ahmed, that Nigeria may be exploring debt restructuring, even though the government has refuted those claims. Well, joining us now is Gospel Obele, CEO Streetnomics. Join us via Zoom there. Great to have you on the program.
Morning.
Hello, Gospel. Great to have you on the program.
Yes, thank you for having me, Ladi. Good morning.
Good morning. So it's all about the debt restructuring going about now, trending. And apparently the finance minister did hint, in that interview, but the government have, taken that back. But is it really a bad thing for us to restructure?
Well, I mean, fundamentally, there is a key revenue crisis, of course, which has led to the debt crisis we find today. There are cash flow challenges right now, and there are a lot of uncertainties into the build-up of how interest rates may evolve in the new year and all of that. So, to the federal government, yes, it makes sense to restructure, but that's still looking for a short-term pathway to a short-term relief, on the challenge we have right now on the table. Until we focus on the core structural and root causal, conversations on the how to, I don't think we're going to get out of this anytime soon, but that's a possibility.
And what is this signaling, to the market?
Of course, it signals that there is a lot of fiscal crisis going on the large part of things, not just the inability to pay debt, but there is a lot of fiscal crisis ongoing. It also signals that there are cash flow problems within the fiscal space. And this is not quite good in terms of investors' confidence, in terms of rolling out understand the fact that the first part of next year or the first quarter of next year would be all elections driven. And that conversation alone will hamper heavily on how public finance are used as instrument, for the conversations or economic inclusion conversations that need to happen. So it's not really positive, and I don't think it's also a very good view for the incoming government as well to deal.
Right, but it's good that the government have actually refuted those claims, at this point. But what are the benefits, of exploring, a debt restructuring at this time?
Yeah, the top of mind is first off that you have opportunities to sort of like pace, your debt repayment and your debt commitment as well. And that, quote unquote, all things being equal, should give you space to do other things, within it. But I mean, it's also a bit dicey right now because interest rates are on the rise globally. So that would mean that the more you think of restructuring your debt, the terms of servicing as well may also be revisited, in that context. And that may mean that you're likely to pay higher volumes or values of monies in terms of trying to restructure, trying to repay or service the debt. Second is the fact that, yes, there is a window that's expected that they could probably make the most of that relaxed period to do more things fiscally and for the economy. We also realize that with elections also come the need for political correctness. That means whatever the government of the day will be spending on will be items that tick the box to help them retain power in the coming season. It's just how it works for climes like ours. So either way I want to look at it, I really don't see the proper how things will really take off in terms of impact and in terms of delivering of the right priorities over time. But the idea makes sense on the surface level.
Right, but I know that the cons, obviously will include, having a bad look, for the country. But what else?
Yeah.
What other cons are there?
It means that over time, there will be a lot more that would have to go into debt servicing. It means that because of the interest rate conversation happening globally now, there also be a downside risk in terms of government revenue as well, being used to fund debt services, meaning that the about 6 trillion that the government will use to fund debt service next year maybe more than that in context because of the interest rate impact. And so, but for me, the cons majorly are the fact that we are not even focusing on what the real conversation is to a very large extent. The more reason why you have this restructuring conversation is because there is a core fiscal and discipline challenge and revenue crisis that we are facing. And until all of that is properly being dealt with, I do not think any strategy in the mid to long term would really help the state of the economy, as it were.
And we saw that comment actually impacted Nigeria's Eurobond market prices there. But how do you see this impacting our credit rating?
I mean, the stakeholders who are involved in credit rating already know the history of this conversation. And technically, what we're trying to tell them is that we are almost insolvent or not being able to pay back our debts. We have cash flow challenges, and there may be other things to consider on the table as well. So I do not really think it will hold a very positive stance for credit rating because it means that you're not being able to stand credit worthy as at when due, and you have to probably come back and renegotiate your terms and all of that. So there is just a question around that, and also a possibility that you have to borrow more next year. So meaning that you're stockpiling on your debt portfolio, and you're looking for ways to restructure how you pay back, and interest rate is also not on the positive end of this conversation. So I really do not think that the outlook is really positive for credit rating. However, if debt monies can be better channeled for better infrastructure or productive streams, then again, that conversation can be countered.
And there we see the government actually planning to securitize debt owed to the CBN via Ways and Means. How do you see that strategy?
Well, I mean, the central, the government is trying to maximize all of the opportunities they have right now, in trying to ensure that these debts are probably restructured, obligations are met, and all of that. So, I mean, the central bank does make sense in terms of finding a win-win around how to just get across today, for another day and all of that. So, it's top of mind. It makes sense to have that conversation, because if you're thinking of that internationally, you should be thinking of that locally as well. And that balancing will help to get the relief that they need to engage public finance in the next economic year.
And do you think that investors will be keen on that security?
Well, then again, there are also interest rate conversations. There are other elements that need to be considered, especially when it comes to conversations like this. The fact that we're going to an election year is also going to disrupt a lot. I mean, these are conversations happening right now because of the current cabinet and other things that we currently have. But once the elections are over, and it's obvious that things may change, there are also questions around what may change as well. So investors are likely trying to watch both the political and doing business landscape to be able to judge all of this debt security conversations and all of that to make decisions. So I do not think that this particular criteria or narrative would be the singular narrative that investors will consider. It's going to be very dicey. It's going to be very dicey in the next coming months, and those the events that will shape the next coming months will shape as well investors' decisions in what to invest on at the end of the day.
Yeah, so much to look out for there, Gospel. Yeah. But in a nutshell, how does this all impact you and I and the average Nigerian on the street?
I mean, it's very important that we've moved past the conversation of a debt crisis. In 2003, 2004, it was a debt crisis. But right now, what we're looking at is a fiscal crisis. And that's at the bane of this conversation. And the fiscal crisis is also what has amplified into the increased or worsening state of the cost of living right now in the country. No matter where you are as a country, if we do not move towards productive streams of engagement and also enabling markets, organizing markets to amplify your non-oil revenue players and all that, I do not think there will be any hope for the common man in terms of doing business, in terms of household finances and all of that. So most of these conversations still thrive heavily on getting our fiscal acts right and working closely with the monetary authorities to ensure that we are delivering economic progress for the average Nigerian. I think the average Nigerian is getting poorer every month, and it's a form of poverty trap, within the context of how the economy is being managed currently. So it's quite unfortunate. Businesses will also have a tough time trying to secure loans and scaling, doing business as it were, and jobs will also be on the line. Retrenchment is also a possibility. Political correctness is also in view based on the elections happening for Q1 next year. When all of these things are considered, I mean, I just think the average Nigerian needs to begin to rethink other streams of income, other streams of investment, cutting down on discretionary income maybe, and also trying to ensure that they have a plan B, to sort of like relieve themselves on the cost centers in terms of cost of living and cost of doing business, as it were. But then again, until the economic moves or tilts toward more progressive or productive-based investments and decisions and all of that, I do not think that this challenge would exit anytime soon, especially in impacting the average Nigerian.
And obviously now, the average investor, at this time, have a lot to think about. But what do you think, how do you think investors here, local investors, can kind of like shield or have some kind of buffer, to protect themselves from the negative impact of all of this?
I think local investors need to rethink how they will be investing going forward. And it would make sense to begin to look at both securities, both businesses and markets, that are evolving within the context of these challenges we find ourselves in. There are much more resilient securities, there are much more resilient markets. There are also markets where you have a stronger consumer purchasing power, regardless of where you are on the conversation as an investor. So you want to think of how to uptake these opportunities and take them in clusters as well. The idea of taking in clusters simply means that you're positioning yourself to latch on that concentration of energy that the market can provide in terms of productive returns. And that's what I also think the federal government should be doing. With debt monies, you can't take out borrowing because you need to borrow to finance a bit of your budget. The concern is, what are you borrowing for and who is spending the monies that you're borrowing? Until these two elements come into the middle and plug in these monies in critical sectors that can drive productivity in their clusters as well, I do not think that there will be any form of significant uptake in returns, ROIs, and all that. Same also to the average Nigerian seeking to think of investment opportunities. You need to think of sectors, markets, and institutions that can help you take the lower risk, and you can also do them in clusters within the time being as well. So those are the initial thoughts I have in mind concerning outlook for investors going into the new year and for Q4.
Right. Well, investors have a lot to chew on there and rebalance, portfolios, try to find where to make money, at these times. Thank you so much. That was Gospel Bele, Chief Economist, Streetnomics Limited. It was great having your perspective on the show.
Thank you for having me, Ladi.
All right, now we're talking about Nigeria's debt level there. Well, let's look at what's happening on the markets there. We got that big drop yesterday, over 2%. We have Ini now to give us the details on what really transpired. Ini, I know it was Airtel.
Yeah, it was Airtel. I mean, I don't know why a single security should have that much energy or strength to pull the market down that much. 2.53%. That was a whole lot yesterday. Very bloody market.
Big drop.
The first trading day of the week.
And about 10% for Airtel. And
yeah,
obviously,
just
when you see a 10%...
Did you see how much the market lost? About 655 billion naira?
Massive.
655 billion naira off the market cap yesterday. That was not
massive
funny.
Profit taking there.
Yeah. All right, but let's start off with what's going on. As Ladi was just talking about the issue of debt, and we see the federal government also looking the way of bonds, the bonds market, to see if they can raise money from there. Already, the federal government has raised about 2.44 trillion naira in 9 months from the bonds market, of course, to deal with that deficit in the budget for this year. Next year, we do have another one, and we've seen the federal government is also taunting the idea of going back to the bonds market. But we'll see some of the implication of that in a couple of minutes. Meanwhile, let's see how the market traded yesterday. The federal government bonds yesterday had 5 deals worth 1.76 billion naira. And we see that it was just the 27th of April, the 21st of January, and the 27th of March 2035 that had those deals yesterday. Looking at the treasury bills now, let's see the treasury bills for yesterday. We only had 1 billion naira in that market for the 28th of September 2023. 1 for 1 billion naira. There you go. That's it. One deal worth 1 billion naira. And then the central bank bills yesterday also one worth 1 billion naira. We've seen the secondary markets when it comes to the fixed income kind of quiet. It's no news that liquidity is tight in Nigeria and other countries. And of course, as Ladi was discussing there, investors are thinking twice before they take any decision at this time. And so that's why we see that the market is not so liquid and activities are not very ripe there. But let's bring in Boswo Bembe now to tell us that there was an auction yesterday. Tell us the results of that. And then this idea of the federal government to cover up for the deficit in the budget through the bond market. Hi, Boswo. Good morning.
Good morning, Hini. Thank you for having me.
Good to have you. How was the auction yesterday?
So the auction yesterday, it was really a poor one, which is is one of the worst we've seen in recent time. The total successful bid was about 107 billion. The DMO was looking to raise about 225 billion. So, but the lack of liquidity in the system due to the increase in the CRR by 500 basis points. So we see a lot of banks are actually not keying in buying these bonds. So that was a shortfall from the DMO from that side, just the same way we had it from last week Treasury B2. So the auction closed, the stop rate closed higher. The 2029 closed at 14.5, 2032 closed at 15%, and the 2037 closed at 16%. So it's really a tough time for DMO to fund the shortfall.
Yeah, it is. And we can say this is because of the tight liquidity in the economy, right?
Yes, that's correct. The tight liquidity due to the increase in the MPR and particularly the increase in the CRR by 500 basis points, which CBN debited most bank for the shortfall. So that actually mopped a lot of liquidity out of the system. So I think we've seen the impact. The inflation rate, though it increased by 25 basis points to 20.77. But if you look at the increase compared to the previous month, so it's been increasing at a decreasing rate. So the lack of liquidity is what is actually impacting the appetite for this for the security.
So we can say that the CBN or the MPC is actually effective because what they wanted to do was mop up liquidity, and that's what they're doing. But the problem is it really solving the problem of inflation? Because we saw inflation out yesterday, even though that was for September, and it wasn't tapering.
Yes, it's actually having impact. If you look at the cost of the inflation, the excess, the money that the increase in interest rate is actually having impact. But I think the major reason why that increase is happening is because is to control the exchange rate to actually reduce speculative buying by customers and maybe banks. So I think that's what has been making the liquidity to the increase had impact on banks. And there was a circular from the CBN saying that bank has to fund if they want to come for maybe FGM bond auction or any auction that CBN is conducting, they have to fund it from the market. So the liquidity is tight because most banks, they've already invested earlier. So their money is tied up. And we are not seeing maybe like maybe bond buy back coming into actually popping money into the system. So it's quite tight for bank.
Mm. And then now we hear the federal government or the DMO talking about bonds buyback instead of debt restructuring. Help us to understand. I know the UK did that recently. I think that was just last week or so. Help us to understand how that could work if they go ahead with it and what possible implications it could have.
I think it is an option that the DMO can explore, but not at the moment, because it's more like it's kind of contradictory to what the CBN is trying to do, more like it's a conflict between the monetary and the fiscal, because CBN is trying to rein in inflation. And when you do a
All right, seems we lost Bosun Bembe there. I hope we can get him to finish up that thought. While we wait for that, we see that bloody market yesterday. Now the equities lost 655 billion naira off the market cap yesterday. All share index was down 2.53, and then the equity cap was at 225 trillion 254. I don't know. Well, if we could see those that also drove this, or some of the other factors for the day there, activity. With so much activity, well, we can expect the activity chart to be in the green, but don't be deceived by this. It was a very bloody market. I think we have Bosun Bembe back. Hi, Bosun, are you back?
Yes, I'm here.
Okay, could you finish your thoughts? You were talking about some of the implication of that bond buyback.
Yes, I was saying that the one for UK was done to actually get the pension guys because there were no buyers. So it is when you don't have people buying the bond. You know, when you don't have people buying the bond and there is a demand. That's when you see there is no demand. Then the rates start going up. So what the government tries to do is to come and buy so that they can reduce the interest rate and try to activate the market. But what we are seeing currently is CBN is trying to actually increase interest rate. So it's more of contradictory to if government comes back to come and buy bond. And at the moment, it will be very difficult to fund it because buying back the bond meaning that increasing the debt stock, which will be funded by maybe CBN. And we already know that there is a ways and means which has a bit increased. So I don't think it's something that can happen now. Probably it's an option that can be looked at maybe maybe subsequent year.
All right, thank you so much, Bosun Obembe, market dealer, joining us with your thoughts and observations this morning. Enjoy the rest of your day.
Thank you.
All right, Ladi, I think that's all that I can take at this time. So we'll see if investors, institutional investors like you, would take advantage of the dip from yesterday. Haven't gone down to 2.53%.
Yeah, it was big drop.
Big drop. Very big drop. I mean, let's see if, I think it would be interesting to follow up on Airtel. I mean, if they dropped that much, 10% yesterday, which is the max.
Second 10%.
Yes, second 10%. Last week they had 10%. This week again 10%. Yeah. And we've not heard that they recovered. Yeah. So that could be about 20%. Let's see if investors will take advantage.
20% will be nice, though.
We still have Geregu anyway.
Exactly. All right, Eni, thank you so much.
Thank you for having me.
All right, we'll take a break now. When we come back, we head to London. That's in a moment. Do stay with us. This is Business Morning. Welcome back. Still watching Business Morning live on Channels Television. Now let's head on to the UK. Now we have Juliana standing by right there. Great to have you, Juliana. So trade unions are sounding the alarm that UK workers are facing 2 decades of lost living standards. Quite intense.
It is quite intense. Good morning, Laddie. That's really the sentiment that is going to be spread by the outgoing TUC Secretary General Frances O'Grady. She's going to be addressing members today. She's outgoing because she's going to be a Labour peer, but there is lots of tension amongst workers, particularly those that are represented by the biggest unions, including the RMT, the Congress Workers Union. They've all been striking over the summer, and it is predicted that we are going to see a winter of discontent, which is very reminiscent of what we had in the late 70s under the Conservative Prime Minister Tim Heath, because people are just not really happy at the moment, particularly if you are a public sector worker. They're not seeing their wages rise in the level of inflation. We are going to be having inflation data tomorrow, and it's expected to go once again into double digits, and they are asking for change. And now what we did see before Liz Truss was instated as Prime Minister is that there were suggestions the Conservative government were going to change rules about industrial action, making it pretty difficult for striking workers to be able to get their proposals across the table, because they said that they were going to replace some of these workers with agency staff. They're really not happy about that, and that is one of the discussions they're expected to have in Brighton during the conference over the next couple of days. Sir Keir Starmer, the Labour leader, will address the TUC, I believe, on Thursday, but he too is under increased pressure because he has, of course, over the past couple of months instructed shadow ministers not to join the picket lines, which is a rare move for Labour ministers who have, of course, always in the past stood hand to hand with unionists. But of course, there is a huge shift now on whether or not that red wall, which Boris Johnson was able to break down during the 2019 general elections, is indeed linked to the Labour Party. So it's all going on. There are suggestions that over the next couple of months, up to 2 million workers in the UK will be striking, and it just goes to show that the economic crisis, which we seem to have tried to bat away by changing, who's got the keys to number 10 and number 11, is not going away anywhere. So we're going to get some really interesting sound bites over the next couple of days out of Brighton.
Right, we're watching out for that. Workers feeling the pinch globally. But the markets, yes, they reacted positively to Jeremy Hunt's proposals yesterday. How's it looking today?
Not bad, pretty decent. The pound and the FTSE are up, but yeah, goodness, what a chaotic day it was in Westminster yesterday. Not many people feeling sorry for Liz Truss, the Prime Minister, only been in power for 6 weeks, who's basically been pushed into the corner, told to keep mum, whilst, the Conservative establishment tried to settle the markets. That's really what happened yesterday. Jeremy Hunt, the new Chancellor, the de facto Prime Minister, he certainly got the kind of prime minister status around him at the moment. He ripped up Kwasi Kwarteng and Liz Truss, to be fair's fiscal policy mini budget, aka maxi shambles, only keeping one or two things. I suppose the most notable thing that he kept was the reversal of the hike in national insurance from 1.25%. That is going to be reversed, but everything else has been ripped up. And he did say yesterday in the House of Commons at the dispatch box that there are still going to be some very difficult decisions that will have to be made over the next couple of weeks in order to get the coffers back up so Britain can pay for its debt. So it is going to be very difficult. I think, normal people are starting to react to the reversal yesterday, the reversal of the tax cuts, the £2,500 energy bill guarantee, which we were all depending on to keep our energy bills down. We were promised that that would last until October 2024. He says it's only going to last 6 months, and we are starting to see businesses and individuals react. I think the sentiment in the country now is that, the Conservative government for 12 years have been in power far too long. The Conservatives don't want Liz Truss. That has been made abundantly clear. Is there going to be a general election? It's very, very likely. And, the Labour Party are chewing at the bit, ready to get in power. And I think the public are ready for them too.
Right. Well, all eyes on Liz Truss at this time. Thank you so much, Juliana.
Thank you.
All right, now let's head on to other markets. Let's see what's happening quickly now in the cryptocurrency space that we see still extreme fear in that market at 22 points there. Extreme fear. Look at the market cap for total crypto space this morning there. We see the market cap there still holding strong this morning. We'll flip over to the market cap. We'll see how that's looking at this point now. And we see the price of Bitcoin holding strong at that 19,500 level there, $19,652, up 0.44%. We see volume traded $27.29 billion. So we see Bitcoin still trying hard to hold on to that 19K level. Let's bring in Olumide Additional now, financial market analyst, to bring us up to speed. Hello, Olumide, great to have you.
Yeah, thanks, Ladi. Good morning.
Yeah, well, we see Bitcoin there still holding on, but we don't have any bad news or bad data out yet. What are you seeing?
Well, I think one should give credit to the fact that Bitcoin is still holding the 19,000 support level, understanding fully well that inflationary pressures across emerging markets, particularly the United States, United Kingdom, and the European zone, is still tickling high. And that's what that means, that central banks would really attack such inflationary upsides. But interesting thing in the crypto space is that growing adoption, particularly among institutional brands, we saw reports that MasterCard is working with some banks, and the exposure MasterCard has with transactions that really gives some positivity around the crypto space. And also the fact that we are a few months away to the World Cup, and fan tokens trading volumes have surged from 2.2 billion in January to over 6 billion as we speak. Tells you the fact that the excitement across sports also is triggering the adoption in crypto assets. So despite you see a moderation in price assets across market spectrum, you could say that institutional adoption is really giving that support. And that's why you still see that Bitcoin is fairly stable compared to risky assets, Ladi.
All right, but we'll keep watching to see if that stability actually continues this week. Any other market-moving data coming out?
Pretty much nothing very uptick, apart from the fact that we're going to listen to selected US Fed officials talk about the high inflation mandate and what is happening in Russia, Ukraine, further create some geopolitical uncertainty. But apart from that, I think the market is fairly stable to say that we might see Bitcoin breaking above the 20,000 as we see equities market bouncing once again, starting with European stocks,
All right, we're interested to see if Bitcoin can actually break that 20K resistance again. We'll keep watching, see how that happens. Thank you so much, Olumide Additional, financial market analyst.
Yeah, thank you.
All right, now we flip over the top pulse by market cap there. We see it's all green on that counter there. Those marginal gains, 1.15% uptick there from BNB. And we see XRP 1.57% up 46 cents, holding that 40 cents level. All right, that's it for the markets, and that's it for the show today. Thanks so much for watching. Don't forget to join us at 1:30 for Business Incorporated for more updates and developments in the world of business. Remember, you can watch this again on our YouTube channel. Just search for Channels Television on YouTube. Flip over to a video section. You can watch all our videos. Thank you for watching. I'm Ladi Williams. Bye for now.